Hello, everyone, and thank you for joining us here today. I'm Denis Rudenko, and this is my partner here, Oleg Shiller. Together, we're going to try running this whole podcast thing. We're hopefully going to educate and dispel some myths and talk about ourselves, hopefully not too much, and why we do what we do.
Absolutely.
So, without further ado, Oleg, let's get into it.
Yeah.
Tell us about yourself. Why are you here? Who are you? And why did you start Oz Capital?
So, thank you for this, Dennis. I love telling the Oz Capital story because it's a very exciting story and it's very adventurous. And the reason why I say this is in that story, there's a specific chain of events which led us and Oz to what it is today. Personally, I've started my career in the financial services industry was a bank.
Mhm.
I was in the capacity of a personal banker. I was kind of climbing the corporate ladder, wanted to get all the way to the top. Changed a few positions, of course. And my last position was of a financial advisor.
Okay.
It was like a dream come true for me. I was 21 years old, and here I am, have all these tools and abilities, and work with high net worth individuals, working on their financial plan. And it was very exciting for me for several reasons. Uh, Primarily, number one is I got to learn the exciting world of investment management. And not only this, but also the individual products, how do you manage portfolio, the strategies. Very exciting, lots of knowledge. The other best part was I actually got to work with some amazing families and specifically working with their financial affairs, building a financial plan.
Mhm.
And not just the financial plan. We would really take a holistic approach to financial planning, meaning taking a deep dive and more comprehensive look at the quadrants of financial planning, from the investment planning to financial planning to cash management, debt management, estate planning.
So
And
like a family office.
it was basically to that extent, yeah. And the best part about the bank is that the bank has so many different departments with all these specialists, investment specialists, estate planners. So you kind of get to work with all these super smart individuals to come up with unanimously amazing plan for a family. And this was very exciting. And then you build a plan, and then you supervise its performance, and then you see how it does over time. It was very exciting for me.
Mhm.
Right before I quit the banking career, I had a few conversations with some of my colleagues. And I said, well, if you would be in my position, what would you do?
Mhm.
And they said, well, why don't you try to become a mortgage agent? What do you mean a mortgage agent? I thought people go to the bank to get their mortgage. Well, if you become a mortgage agent, you will have more options for your clients and you're going to be self-employed and, explore that. So sure enough, after a very long decision, I think it took me about 30 minutes to make that decision. I got a license and I began my career as a mortgage agent. And it was phenomenal for several reasons. Number one, I was no longer tied to anything. I was an entrepreneur, which is something I really wanted to do since I was a little kid. I wanted to do things on my own accord. And now I had all this time to do what I wanted to do and build my practice. Number two, I've joined a brokerage which had access to 30, 35 different financial institutions.
Mhm.
So I'm not pushed to sell what is profitable. Now I'm free to select the right type of a product and make it more customized for my clients, right? And really watch them succeed.
Mhm.
And number three, again, I was back at working with families. But now more on the debt side, going through those emotional moments of the first purchase, advising on the right mortgage solution, which I became so good at, refinance, equity takeout. So I was able to address everything and pick the right type of a product, which was that feeling of flexibility.
Mhm.
I've done it for a few years. 2 years later, and I'm talking this was 2006, I was introduced to my business partners, Vika. We joined forces and we're never looked back. Yeah, and was literally on a handshake. And done it for a few years, and we did very well. But 2008 comes in. And of course, for all of us that know, and most of us do, the bank crisis in the United States. And it was a pivotal moment in our career because I'm proud to say that because of that unfortunate set of events in the past, it led us to where we are today.
Right.
It was a crazy year. I don't think we had many calls coming in for business for the first, say, 4 or 5 months after this event, which is normal because the industry is changing. Nobody really knows what's going on. Banks are in disarray, they're trying to figure things out. But, we kind of sat down and, we looked at it objectively and we said, well, there must be an opportunity here. It became increasingly difficult to qualify borrowers. There was a whole bunch of changes which were made, which, you really, as a broker, you needed to be on the up and up. Things like reduced mortgage amortization, and obviously banks are trying to be more careful at lending. Much tighter ratios to qualify borrowers, up to the stress test in 2017. So there's a whole bunch of events which took place from 2008 to 2017 for us to make the pivotal change to where we are today. So as it was increasingly difficult to qualify people through a bank and get them a normal mortgage, we kind of been toying around with an idea, well, what do we do now?
Mhm.
We need that flexibility. We need to step outside the box and be creative if we want to find the right solution for the clients. And it was a big burden on the clients too, because, they were struggling with qualifying. Before they could, now they can't. So what do? How do you transition? So we became creative. I had access to a few of the guys with my Vika had access to a few of his guys. We had a few of our relatives, and we kind of said, okay, well, let's try private lending, right? And our clients' needs became increasingly challenging because we were dealing with real estate investors. They were building up investment portfolios. They always wanted to buy the next property, but the main question is, how do you qualify them, right? So our investors were benefiting from it because they had a great rate of return that they were making. They were secured against a specific real estate, and in essence, they were getting top of the line bank type clients. And borrowers were benefiting from this because they were able to buy the new property. They were able to solve their problems if it was an equity takeout that they needed to do. And this is where the both sides have benefit. So it was and it was growing great. So we have two sides of our business now: the institutional lending and we have private lending, right? And both sides are growing pretty fast. So it was 2015 when we opened OS Capital as a brand and also became licensed as mortgage administrators. Now we could provide our investors with this phenomenal service of servicing their mortgages, growing that side. And at that point, it wasn't just our clients. We were promoting private lending to our fellow brokers out there. And they were sending us deals. So now you can imagine that both sides are growing exponentially. And, which led us to the final pivotal decision. It was 2019. We kind of sat down and we said, look, we have our institutional business that's growing. We have our private lending practice that's really taking up. We got to make a decision. Like, where do we go from here? You can't really scale both businesses. You got to focus on one and really excel at it. And it was a huge decision because imagine, as a broker, now you're in business for 15 years. You have your established clientele base. You're making a lot of money in commissions. And to walk away from it and go towards private lending was a very tough decision, but we needed to make that decision, and we did it. We were introduced to a very high producing broker, a great gentleman, and we decided, okay, we're going to outsource all the business to him, and let's focus on private lending. And here's where we are today. From 2019, we had about $20 million in assets under management to where we are today at $115 million in assets under management, with just clear focus and understanding where the need is and just going towards it. And I'm extremely proud to say that we are where we are today because of all these moments, that pivotal moments where we kind of took back thinking and realized the opportunity and seized that opportunity. So Denis,
Yes.
you've been with us for a little less than a year.
Sure.
How are you finding the company? What's it like? Share with us.
I'm very excited to be here. This probably more excited than on the first day that I got here, to be honest with you.
Yeah.
It certainly is. It was different than I expected it in the scope of the role and what I do day to day. Again, I had no idea, and I think our roles are ever evolving, and I think that's just part of being in a smaller kind of boutique type business, right? I love it. I mean, every day there's something new for me to do, and there's something new for me to learn. Oz is a great business, and we're really trying to be at the forefront of what we do and the industry. So it's been an excellent first year, almost first year. You know, I started off in this industry at a very volatile moment that you mentioned earlier, in just after the '08 sort of '09 great financial crisis or mortgage crisis down in the U.S. So it was a very difficult time to get into the industry. I went to university for finance and economics, and in Toronto back then there was a lot of kids my age doing that same degree.
Yep.
The only thing that got me into the business was actually that I speak French, parle français. Alors ça m'a aidé. It helped me a lot because there wasn't a lot of people with my
I have
background.
no idea what you just said. So
That's all right. You don't need to know. Um, but yeah, so it really helped. It helped me get my foot in the door at a big a big mutual fund company that massive, one of the biggest ones in North America. And really, that was like trial by fire, right? I was there for almost just shy of 7 years, and I progressed through a bunch of different roles, and really realized, I learned a lot about the inner workings of a fund company, the back office, the kind of the operational side of things, and it made me realize that I love the industry, but at the same time, it also made me realize that the interactions or the parts of my job that I liked the most was working with clients, working with people. So I decided right then and there, despite the fact that it was a difficult decision because it's a scary thing, to get myself out of my comfort zone and to move, move towards a more sales oriented role. So I ended up leaving the big company in favor of a smaller firm. Um, and that's when I discovered alternatives, which was still new back then, right? This is, now we're talking sort of, 2015, 2016. They've been around. There's a few companies, and Mix have been around for a long time, and other products, but really, like, they weren't widely accepted by the public and the retail advisor channels,
Right.
right? Like, there were some advisors using them, but they really weren't as popular as they are today, and I'd argue they're still not popular enough. Um, that's basically it. And then fast forward, it's several more years, almost 10 more years now, and here I am at Oz, and
yeah.
it's great to be a part of a company that's, like I said, that's we're certainly a boutique. We're certainly, not like the company I started out with, where I was just a number. But I love it, and I love the challenge of working with clients on a day-to-day basis, of doing all the little things that make the company run and that make our clients money, and that make everybody happy at the end of the day. So yeah, it's been a great year. That's a long answer.
No, that's good. That's good. And thank you so much for this introduction. I want to say that the very reason why we're successful is because of our people. And though it took us so many years to build the company and build it properly with roles and procedures and controls in place, we would never be as successful as we are today if it wasn't for the people who help us move ahead. So we're extremely fortunate and very grateful for everyone who is with us. I want to talk about the Mortgage Investment Corporation. And the reason why I want to do that is because I have multiple conversations with clients. You have multiple conversations with clients. I'm not sure how it is for you, but what I've noticed is not a lot of people actually know what a mortgage investment corporation is. And not a lot of people actually know what private mortgage lending is. So I'd love to give our audience enough information about, in simple terms, what mortgage investment corporation is and kind of what the benefits are. Who are the participants?
Yeah.
What are the benefits? So maybe I can get you to start this.
Sure,
and you can explain this.
And you're right. Like, I mean, there's we always talk about making assumptions with our
Yeah,
clients, right?
yeah.
Like I think that's one of the overarching themes in our business.
A
Is
brutal mistake. You never make an
we
assumption.
always think that people, not that people aren't intelligent, but we always expect people to know about what we know,
Yeah,
right? But that's why there's so many experts in so many different fields, right? If I'm
exactly.
going to go to the doctor, I'm not going to I'm not going to expect you to tell me, about why my foot hurts, right? It's like the same way that,
You need a specialist.
exactly, you need a specialist. So one of the worst things
Yeah,
we do is because it's second nature to us, right? We make assumptions. So you're right. A MIC is essentially it's a pool of investors' money or capital
right.
that is held within the corporation, and then that pool of money is lent out to a pool of mortgages, right? So it's a diversified portfolio of mortgages. Now, those underlying mortgages pay interest on the loans, and then that interest is passed through the corporation to the investors, typically on a monthly basis. So essentially, that's what a MIC is. It's a very simple concept. It's been around for a long time, right? Um, but it's only recently, really. I mean, within the past, say, 10 years or so, that
They became so popular.
yeah,
And to kind of add to this, because I've been a broker for so many years, the popularity around creative financing is really attributed to mortgage investment corporations, which became lifesavers,
hmm
especially if people are unable to qualify for a conventional mortgage, which most of us have found ourselves in this position. You go to a bank and it's ever so difficult to get a mortgage, and you
yeah, yeah,
ask why. And it seems like by the time you get one through a bank, you walked all the way to the end of the earth and back,
hmm
which is a problem. Mortgage investment corporations became lifesavers. Uh, in business of providing that necessary and needed bridge financing to help borrowers accomplish their financial needs when it gets to real estate. The main question is beyond the obvious, like, who are the participants? Like, you have your investors, you have your borrowers.
hmm
So if I'm an investor in the MIG, like, what are the benefits to me?
First of all, there's two very distinct sides, right? Exactly, like you said, it's borrowers and investors, and I think on both ends we can talk. We can talk, just to give some examples, because even for me, when I first found out about mix, and you say, well, the kind of the general perception, the layman's perception of a MIC is, well, why would somebody need to go to an alternative lender, right? Well, it's because they have bad credit, or they can't qualify. Why wouldn't they qualify at the bank? But you and I both know that that's
That's not
not the
at
simple
all
truth
the
of it.
case.
No, that's not the case at all. And again, we can expand on that, but maybe you can expand on that, and
Sure.
I'll talk about the client side because that's primarily who I deal with. A MIC is really something. In plain terms, it is a fixed income type vehicle, investment vehicle, right? It's a vehicle that is very much like a bond that provides a coupon payment, right?
Right.
Um, so essentially, and okay, that's getting a little too complicated. Let's just in simple terms, it provides a monthly cash flow in the form of interest income, and typically that cash flow is very steady because it is a targeted rate. The portfolio is set in such a way that we make our target rate 99 or 100% of the time, right?
Yeah.
So it's a very steady kind of relatively high yielding investment that's meant to sort of be a dampener in your clients' portfolios. I think a MIC really is for anyone. I think all clients should have exposure to alternatives,
Yeah.
right? Like I'm
Absolutely.
sure you would agree.
Absolutely, absolutely. And I think it's important to note, to your point, when I personally think of a mortgage investment corporation from the investor standpoint, there are several very obvious benefits to me. Number one, I invest my money into a well diversified pool of mortgages. And I think it's important to note that there are different types of mix out there. Our mix specifically is purely residential.
Mhm.
So we kind of, on the KISS principle, keep it simple, right? Invest in residential mortgages
I
only.
think I think you left a word out
I intentionally did that, actually.
there.
I intentionally did that. But, the main benefit is you want to have access to an investment which not only produces a sustainable yield, which in our case is 9, as you mentioned, 9% per year annualized yield, which we're paying on a monthly basis, which is another benefit. I'm investing money into a well-diversified pool of mortgages, right? And in doing so, I already am staying diversified. And not only this, I know that every dollar that I commit in a MIC gets secured by real estate. So there's a security attached to it. As an investor, what's important to say is, I get shares, common shares in the corporation for every dollar that I put in. And if I put $50,000, I get 50,000 shares of the corporation, which in essence is a flow through. This is how I collect my income. MIC pays monthly, which is a big, big deal. So which means that in your non-registered money, it's your regular cash flow, and in a tax-free savings account, you collect money per month. And it's so important because now we can kind of have a conversation around financial planning and whether I'm trying to supplement my income or bring a little bit more into the play. Cash flow wise, this works phenomenally well. I also want to mention the subject of democratizing investing. What does it really mean? Like, it's a big word, democratizing investing. And it really is, in simple terms, giving people equal access to invest into this wonderful vehicle. Because we had a conversation on this before, me and you, where many years ago, products like mortgage investment corporations were complicated in nature and were only reserved for the ultra high net worth and sophisticated investors. And to me, it's not fair if people don't have access. It's a misconception.
It's really a misconception, I think, right? Because I mean, to a certain degree, it is a. I think the regulatory bodies do a good job in obviously sort of encapsulating and providing the standard rules and guidelines by which everyone abides. But in doing so, I think they've created this big heading for alternatives or exempt market products, which aren't really the same thing per se. But the thing to note is most of those products are fairly complex, right?
Yes.
They're debt instruments, and the creation of those products is complex. And certainly, certain ones of those products should not be purchased by, everybody. But and what I'm trying to say is, at the same time,
without proper explanation of what the product is,
and without having, a proper kind of
understanding,
due diligence process around it. But at the same time, I think one of the big roadblocks is, I have to be an accredited investor. Well, you don't actually. It's not just for accredited. You can be an eligible investor, like we've discussed, right? So to be an eligible investor, I mean, most people, for example, in Ontario, the average income per year is $63,000. Right. To be an eligible investor, you need to have made $70,000 per year in the past 2 years, or $130,000 as a couple or as a household. So, maybe not everybody, but a good chunk of the population would be considered eligible investors, and there's other criteria that can make you, as an eligible person as well.
So here comes the best part.
Yes,
democratizing investing means that we give access to this product to a wide variety of accredited and eligible investors. The best part is that the minimum investment into a mortgage investment corporation, specifically with us, is only $5,000.
Yeah.
So because we're big believers in giving everyone access to this great product, and what's more important is you invest into a MIC, and you don't have the hassle of the daily, monthly management that we do behind the scenes on collecting payments and managing mortgage investment corporation on the backside. It's a big undertaking, especially. You are a private lender without the hustle of being a private lender, which is the main advantage. At the same token, you have this opportunity to diversify your portfolio if this investment opportunity is right for you, right? And have an element of private lending in it without being a daily manager.
To me, I would say that every single individual, Canadian investor that has a TFSA, has an RSP, has some level of savings, and I'm not just talking about OSMIC, but in general, again, getting back to my love of alternatives,
Yeah.
because obviously we're going to be biased to a certain degree, but like I would never tell one of my clients, because I'm registered as a dealing representative, right? So
Yeah.
I have
Yeah.
a duty to my clients. So if a client comes to me and goes, "Hey, Dennis, I want to give you, 40% of my portfolio," I would say absolutely not. I mean, I
Yeah.
would love to, but it is not a suitable investment, right? Like that is just not it doesn't that kind of an exposure doesn't make sense. But again, when we talk about um, a 10-20% exposure, whether it's to Oz, whether it's a combination of products within your portfolio, I think that is something that every single Canadian should have within
Right.
their portfolio, because we've seen what markets can do.
Absolutely.
You,
They're
you know,
so unpredictable,
and
so uncertain, especially now.
I mean, when you have both the stock market, the equity markets, and bond markets moving in tandem down
Yeah.
together,
Yeah.
like we just saw, it's like you're losing on both sides, right? So I think there's a strong case to be made for things that are less correlated,
Yeah.
and typically most alternatives tend to be that way. Now again, for us, it's a nick. There's other products out there as well, but for our intents and purposes, we're talking about Oz Capital. So
Absolutely. So, um, I want to come to you as a client, and I think it's important to discuss a typical situation.
sure, how much money do you got?
More than a little and less than too much.
Uh,
If I'm coming to you as a client and I'm saying, "Oh, look, Dennis, I have blah 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 blah. I have 200,000. I want to give you 200,000." Obviously understanding that, okay, that's great.
mhm,
But now we have to take a dive into your personal financial situation to understand, number one, is this the right type of an investment opportunity?
absolutely.
Okay. Number two, how much of that said $200,000 we can actually take on based on the type of a client you are, whether it's an eligible or ineligible or an accredited or non-accredited investor. Can you walk us through a day in the life of having a conversation with an investor, and how do you get into qualifying them?
Sure, sure. Yeah. I mean, look, no, I don't think, I've since a year ago, I've probably worked with uh, now close to 70 or 80 individuals, maybe more, maybe less, from our existing investors that have,
Yeah.
added to new investors that have come on, to prospects, to whatnot. So, and I can tell you, no individual situation is like another. That's one of the big
Absolutely.
things that we've realized,
That's why we customize, right?
and that's why, and again, to a certain degree, we aren't a full service shop in the sense that, like, I'm not going to tell you what to do with the rest of your portfolio. But when it comes to qualifying, and kind of trying to help you and lead you on the right path, um, most of the way it works essentially is we really look at a few different aspects, right? And this is part of the KYC, or the know your
The
client process,
qualification, yeah.
right? The know your client, basically, it requires me to have a very full understanding of the individual, their family, their income, their goals, things like, how old their kids are. Like, if I need to understand where they're coming from, what is their general, needs, what's their time horizons, things
Yeah.
like that. So, I can have two very different, we just had a conversation with, I just had a conversation with, like a couple that's retired, that's been retired maybe, I think, for 5 or 6 years. They retired a little bit early, so they're in their mid 60s, and they're quite affluent. You would say,
Yeah.
they have
Yeah.
some pretty good savings in both their retirement accounts. They've got a pretty healthy picture, right? They own their house and everything else, but really, like, for them, I have no concerns because they have a good level of assets, right? Between the two of them, they've got well over $1 million in their retirement accounts. They've got their TFSAs maxed out, right? They own their house outright. They own their cars. Like they don't have any liabilities. Like that's another important thing, right? Understanding the debt levels, things like that. So if and they came to me and they said, "Hey, look, like we love this." They've had some experience doing syndicated loans, like private deals. So
Dabbling into private lending.
they've done lending themselves, right? Which so I'm like that to me, because that's another aspect is what's the knowledge level and the risk appetite for a client, right?
Absolutely.
Like so those are another big thing that we look at. So, for somebody like that, or this couple, where they come to me and they say, "Hey, we want to give you, 10 to 15% of our, global financial worth, not
Investment
net
portfolio.
worth, but financial assets," right? I would feel pretty comfortable going ahead with it because, again, they're not overly concentrated. They have liquidity in a lot of different places. They're comfortable. They understand the business. They don't want to do that themselves anymore, which is, not that you shouldn't necessarily, but like
Yeah.
I'd say
Yeah.
leave it to the experts, right?
Yeah, absolutely.
So that's a very typical, but then you can have an older couple, same age, maybe, or not older necessarily, but same age, same situation, but maybe they don't have, that nest egg saved up,
Yeah.
right? Maybe they've only got a couple $100,000 put away, right? That changes the situation drastically. And maybe they have kids that are, still young. Maybe they had their kids later in life, right? And maybe they're still supporting their kids through university, right? So there's a lot of different criteria that play into it, really.
You bring in a great point. And it's important for our audience to know that mortgage investment corporations are not liquid investments.
Mhm.
It's not like something that you can invest, though we have a 90-day redemption policy, understanding behind the scenes that we enter into mortgage contracts with borrowers.
Mhm.
So it's not a stock that you can sell right away and get the money tomorrow, or a GIC. We need 90-day redemption in order to be able to give you your amount back. So to your point, when we're looking at clients potentially that we're trying to onboard for the MIC,
Yep.
we're very conscientious about their liquidity requirements. We're very conscientious about where they are currently financially and where they're going to be and where they want to get to. We want to make sure that we're able to address the needs that and strategies that we will be discussing later in this podcast on what money can do, whether you want a monthly cash flow or maybe you want to let the money accumulate over time and kind of take advantage of the compound interest. So I wouldn't say that it's a rigorous process to qualify investors, but we have had investors that we had to turn away because we didn't feel comfortable that this specific investment opportunity is right for them. And we will do that because we want to make sure, and we have this fiduciary obligation to do what's best for the client, not what's best for the business.
Mhm. Yeah, and I mean, ultimately, if a client still wants to go ahead, even though we deem the investment is not suitable for them, they can do a client directed trade.
Yeah,
And
of course.
they could, like, at the end of the day, the client can do whatever they want.
And they make the decision what they
And
want to do with their
but the
money.
biggest thing is the liability becomes on them versus on
Absolutely.
me as a dealing representative. And again, not to say like mix come in many different shapes or sizes,
Absolutely.
right? Like it's a very broad category of investments. I think the key is really understanding the risks and really what the underlying assets are. Right, that's a huge thing, and I know we have a very rigorous approach to risk management at all. And like you said, we keep it simple. We keep it
Absolutely.
simple. That's a huge thing.